Shopify, as we mentioned, stock soaring today. But there's also tariff uncertainty continuing as the U.S. president raised tariffs against India to 50%, objecting to that country's purchase of Russian oil. For more insight in the investing environment, let's go to Patrick Horan. He's the principal at Agilith Capital. Thanks for joining us today.
Thanks for having me on.
So TSX on a tear this week, a new intraday high today after yesterday's record close. When you compare the TSX to the American markets, what are you seeing?
Well, I think when we had the job revisions on Friday, it changed the interest rate structure and provided more incentive for central bank cuts, which is good for the cyclicals and tends to be bad for kind of long-dated assets. So I think what we're seeing right now is the Toronto Stock Exchange play a little bit of catch-up here as we get the steepening curve, with anticipation that we'll probably have 2 or 3 rate cuts in the U.S. and in Canada for this year.
Okay, so let's talk about what you say the playbook will be for the next part of the year, because you're saying it'll be very different from the start of the year. How so?
Yeah, I think we kind of flipped the switch on Friday. We were coming into the year thinking things were pretty steady. Tariffs and consumer pullbacks couldn't shock the economy. Things were just on a roll. Canada looked like it was going to continue to struggle, and Friday changed that. Friday basically revealed that we've actually had about 3 months of slowdown in the States, and we had thought that there was a pretty good pace to the economic growth. And that Canada was in a slowdown. And Friday showed that Canada actually accelerated a bit to our surprise. So I think in the U.S. The assumption, certainly our assumption, would be before Friday that any central bank cut would have been a mistake. It would have steepened the curve significantly and caused the potential for a debt spiral. So interest rate costs to rise at a faster rate than deficit spending. And that would have been a mistake. And it looks to me like there's probably a go-ahead in the short term for the Fed to reduce. At the same time, I think the Bank of Canada has been holding off on. They've had room to reduce. But they're very currency sensitive right now, especially, and the interest rate differential with the States basically hasn't allowed them a lot of leeway. So I think this is going to give Canada, or the Bank of Canada, more leeway to cut along in line with the U.S. All that being said, very long-winded way to talk about this, that what's been working for the first half of 2025 is probably going to change into the later half. We think it's more cyclical here. We think it's a little bit more commodity-based, more industrial-based, more value-based. That's our belief. We don't think the techs and the stocks that have actually run on momentum are going to continue here. And what we're seeing with the likes of Thomson today and AMD, we're seeing sharp sell-offs if they can't really attract new money coming into it. So that is if they're just in line, who wants to buy more? If it's done well, it's probably an overweight in the portfolio you want to trim anyway, and everyone rushes the door to trim. And what you get is a big pullback that no one saw coming. So I think that's what we have.
Let's dig into a bit of the earnings picture a little bit more. We mentioned Shopify, which is soaring after profit grew 31% in its latest quarter. Is there a larger e-commerce push going on that you see maybe continuing for the rest of the year?
Well, I'll tell you, technology is something we've stayed away from. So I haven't really had my finger on that pulse at all. I have been very surprised to see Shopify trade at the multiples that it has and the growth rate that it's achieved. So I'm probably, I just look at the world through a different lens here. I'm a value guy. I look for opportunity when no one else is looking, and Shopify is a different planet for me, and
Okay.
so. Having said that, this race to compete online and to get out of the physical asset world is definitely a real one. Shopify seems to be a great tool for the small business owner that really needs to go up against Amazon and Walmart and gets them this equal footing. That I can say is really their key metric is that small, medium-sized commercial operator, and it seems to be working.
So what are the sectors you are looking to put some money in for the second half of the year?
We haven't really done any changes. We have trimmed positions that have run, and we've bought positions that have pulled back. So we like the financials. We like steel. I think steel, Russell Metals here, looks good to us. It has a very high return on cash, free cash flow, very good operators. We don't see steel tariffs actually coming down, especially ones that are non-USMCA compliant. So we think steel climbs. We think Russell does well in that environment. We do like oil and gas here. We don't play oil and gas directly. We prefer the tool makers. So these are stocks that have not necessarily participated, but Trican is a stock that we have very good operators. Enerflex is another one, compression technology for oil and gas, and they're good operators. Trade at very inexpensive multiples. I mean, non-demanded. I mean, you're paid back in 4, 5, even less in terms of years, in terms of free cash flow. That's an amazing statistic. You don't get that. Your assumption when you devalue a company is that there is a perpetuity to the free cash flow. You're getting this in 4 or 5 years. That's amazing. So anyway, that's kind of what we would lean to in this market. Those are ones that really haven't performed all that well. We think they're winners over the next 6 months.